Hello, Maverick traders. Welcome out to your currency midweek for March 15th, 2023. Plenty to talk about today. Holy moly, is a lot going on here. As always, a quick reminder to make sure that you follow your trading plan, and let's get to it. So, last week, not a lot has changed in terms of my outlook, but a lot has changed in terms of the markets. And that in turn makes me question a couple of things. And let me explain. So, we've talked about we're in a bear market. We played out that full 5-wave down ABC correction. We talked about that for weeks, how the markets had really, through most of last year, finished that 5-wave cycle. And then we had that nice recovery, that ABC. And now we're in this phase, turning down. The short term bounce failed. There was a little bit as we kind of rolled over. We got a lower swing high. It was just perfect setup. And then we kind of have sold off from there again. So last week we were bearish, anticipated markets to go lower, but bearish for a lot of different reasons, not because of bank failures. That was one of what we call an unknown unknown. This was not scheduled. It was not on anyone's radar. And you know our discussion about this. There are many things in the markets that are a known unknown. What are examples of things we know about, but there's unknown consequences? Well, companies reporting earnings, or FDA decisions for drugs, or Fed meetings, or Forex events, right? A central bank meeting, a FOMC meeting, and so on. Those are all examples of what we call a known unknown. We know that the event is coming, it's scheduled, there's a date, there's a time, there's all those sorts of things. And so, although there's some unknowns, we don't know exactly what they're going to do, we don't know exactly what they're going to say, because it's so widely known. A lot of times the markets pretty well know what's going to happen. They have a forecast, and there might be a little deviation here and a little deviation there, but it gets fully priced in ahead of time because it's not a big shock. It's not a surprise. And markets are able to dissect it down and say, okay, here's what's likely to occur. Here's what that means for the future. Here's the path the Fed is on. Even before the Fed comes out, we know it, okay? This bank failure, Silicon Valley Bank, SVB, and all these things, this came out of nowhere, and it was not scheduled, it was not planned, it was not expected. And then there's all of the unknowns. Well, are deposits going to be backstopped? And if they are, does that mean that everything is backstopped? And if that, are we going to have endless amounts of money printing and so on? And so you have to, it comes out of nowhere, and then there's all the ramifications, which can be huge, and that is not priced in. There's just no way for it to be priced in because the market had no idea it was coming. And so from the standpoint of repricing, risk, and all these sorts of things, we got to dissect it. And there's a few different factors here. Some, I would say a lot of them are actually bullish in terms of the short term. Maybe not so great long term, but bullish in the short term. One thing we know is that markets love money printing. They love easy policy. They love lower rates. They love, anything that kind of fuels economic circumstances and so on. That's what the markets want, for prices to go higher. Markets do not like quantitative tightening, higher rates, less availability of capital, slower economic conditions, and so on. So this actually is bullish from that standpoint. The Fed basically backstopping it, the old Powell Federal Reserve put option to kind of protect the markets is in place, and more money printing, the Fed unlikely to raise rates as aggressively. There's a lot of factors that you have to look at this and say, actually, that's bullish, and that's bullish, and that's bullish. In fact, some of what caused the problem, if you looked at the 2-year bond, the bond had been collapsing, and the yield moves opposite, right? Yields were spiking, and it got as high as 5%. This is what got the bank into a lot of trouble, was basically these higher interest rates. They had a duration problem. Now, they got into more problems with the longer dated bonds than the shorter dated, but the point being that because in a risk off environment, people flood towards safety, and US debt is considered zero risk because the US government's never defaulted and they can print money and so on. People rushed into the bond, which actually caused the rate to drop. And it fell from about 5% to 4% in a day, which rates coming down actually relieves some of the stress and some of the problems that were created by the higher rate. So, in an odd twist, by people going more defensive, it's relieving some of that stress in the banking sector. And so as you check the boxes, there's actually some good for equities. This something like this, I've told the story. I love the Chinese proverb of the Chinese farmer, right? And all these things are happening, and they seem like they're good news when they're actually bad news, and they seem like they're bad news when they're actually good news, and so on. And that's kind of the case here a little bit. Now, I wouldn't say it's good for everything. And clearly, markets are getting hammered, and there's stress in the banking system, and we're hearing about Credit Suisse today and all the problems that they're having. So I'm not saying it's all rosy. I'm just saying you can look out to the future and say, will the Fed hike rates as aggressively? It was without this, the Fed was going to raise by 50 basis points. With all of this, I suspect they're only going to raise by 25. The terminal rate, they may stop sooner at these high levels than they were going to before. And you're seeing, flight to safety trades. You're seeing the dollar bouncing sharply today. You've seen gold and silver spiking up. You're seeing things that are more economically sensitive. The commodities that are economically sensitive, like oil, are just getting blasted. So, does this put us in a great path? I would say, from a Fed and policy perspective, there's a lot of more positives for the markets. Rates coming down, that's a positive. Some of these things are good. I would say the economy and economic circumstances, if I can spell it here, this one is a little bit more of a concern. People are wondering if this is going to create, of course, we've been headed towards a recession. It's kind of been a rolling recession where different things are getting hit at different times. Right now, the financial sector is in a lot of stress and a lot of pain, and that locks up sometimes the economy. That locks things up because banks need inter lending and they need to do all these sorts of things. And right now, banks don't really trust each other. They're worried about when the next shoe is going to drop. They're getting defensive. I mean, it does lead us towards a softer economy. So I don't want to sound like it's all rosy. I still think we're in a bear market. I still think we're going to see some deteriorations. But as a trader, I have to consider the short term along with the longer term. Longer term, I still think we're trading down. Shorter term, I think this sell off right here, right now is probably a take profit, kind of a flush out in the near term, and we should see a sizable bounce here in the not too distant future. Economic reports this week: CPI came in as expected. They hit all the numbers expected: 4% month over month, 6% annualized. But under the surface, it was a little bit worse. Some of the things that were inflationary or hurting consumers and so forth just seem a little bit more entrenched and a little bit more of a problem. PPI, however, came in much lower than expected. So you'd have to say, from a Fed perspective, they'd say, well, this was not great. This one moving exactly the way we wanted. Consumer price index, not so great. Producer price index, wow, better than expected. Again, I think this is more towards the Fed saying, hey, maybe we need to slow things down a little bit. We need to make sure that the economy is not collapsing and that the banking sector is not collapsing. Would it surprise you if I said that the S&P 500 is exactly flat for the week? The S&P is flat. Now think about that with all that's happened. Now, of course, we sold off hard last week, but see that massive volume, big flush out? we bounced yesterday. We're giving a lot of that bounce back today. But we're basically flat on the week. We've gone nowhere from essentially where we closed on Friday. That's not true of every market, but that's true of the broader markets. And again, I think from the standpoint of trading, that we've got to consider this as probably a take profit in the near term. You get some sort of correction, consolidation, and such, you probably are going to re-up on the bearish side. But I pretty much always use these big flushes and huge bad news and all that sort of thing. I mean, that's why you were short in the first place. That's why you were bearish. Same thing would sort of apply in a currency. If we've had a big drop, a massive trend down, it's running much lower, and then it kind of capitulates and kind of runs for the finish line, the sprint to the finish, and uses all of its energy, it's probably going to bounce, consolidate, and so forth. Crypto having a great week, as is gold and silver. That makes sense from the standpoint of, again, what the Fed and the government is doing, backstopping deposits, more money printing, the argument to get out of US dollars, out of currencies, and so on. This is made stronger for these types of areas. Now, you might be concerned about, the viability of gold or crypto for spending purposes, but some of that is just a retaining of your purchasing power. And in some ways, you want to be out of currencies when there's more, potential for turmoil and things like that. These are safe haven type of assets in a I want out of US dollars, I don't trust it type of dynamic. And there's a little bit of that going on this week. Oil getting hammered, down 11% on the week. That is more economically sensitive, and it is just getting blasted. So as we look at the markets a little more closely, as I said, kind of an exhaustion low. We're backing and filling today, but I think we're not going to trade below that immediately. I think we're kind of backing and filling, and then maybe even a little bit of a chop back to the upside. So I'd expect a rebound, let some of these moving averages roll over and kind of catch up. And then there's probably an area to re-short, 3% higher, something like that. We would consider it. As we look at the FX markets, Japanese yen by far and away the best performer, euro selling off. And euro looked fantastic. The chart was great, but things change, and that's one of those unknown areas. Crypto in general, stronger, but Bitcoin obviously the big beneficiary of what's happening. It is the most stable of all of the crypto coins, right? It's considered the big, end all be all. It's kind of the core of the crypto markets. All of the rest of these were kind of a derivative of Bitcoin. So it's kind of got that safe haven status. If you want to go to a flight to safety, you feel a little safer in a Bitcoin than a Litecoin or something. So market outlook, obviously we're in more of a bearish mode, below the 20, below the 50, trending lower. I think we're setting up for a short-term bounce, but where I was really quite bearish last week, I would consider myself more neutral on the markets just in the very short term. Kind of expecting a bounce, and that's probably an area to get short. International markets, same thing. They're trading poorly. Should we be using this as a take profit? Probably so, because there should be some choppiness, a consolidation of some sort, or a correction of some sort. But nevertheless, it's still likely to go lower longer term. So it kind of depends on your time horizon, I suppose. As we look at crypto, really a big bounce. So last week we talked about this, and it had a huge drop thereafter. But that huge drop after we talked last week was followed by an even larger rally. So I'm not super bullish on crypto. I've been on record of saying that. But if there is a recipe for Bitcoin or these coins to flourish, it's one of destabilization across the world and specifically in currencies, and a lack of confidence in the currencies retaining their value and so forth. That's the ultimate argument. So a lot of people are disturbed. You can be on one side or the other. Do you like that the Fed and the government and so forth, that they're going to backstop all those deposits, or would you have liked to have let them just have markets play out, right? If they say there's X amount of insurance and then they say, well, never mind, we're just going to cover all of these deposits. You can be on either side of that argument. You can say they did a good thing, you can say they did a bad thing. If you're on the side of the argument that what they're doing is basically risking our currencies and so forth to backstop those deposits, then you don't like what they're doing, and you don't maybe trust the government, and this all leads to, all roads lead to why Bitcoin has even been created in the first place. It's the ultimate, I don't trust the government, I don't trust currencies, I don't trust, it's that lack of faith, basically. When we think of fiat, it's kind of a faith-based thing. We believe in this dollar because it has worked in the past, and we believe that it has exchange value and so forth. If that confidence wanes, it does push people more towards a gold or a silver or a Bitcoin or these sorts of areas of the market. As we look at the rest of this week, so we've kind of crossed the hurdles in the US of the main events. CPI, PPI came out, and the PPI, I mean, if you look at these numbers, both much better. We want to see these inflation numbers trending lower, and on the PPI side, much better. CPI, not so much. We don't love seeing retail sales and economic, circumstances like Empire State Manufacturing collapsing and so forth. That's not great, but the inflation numbers coming down, that is a positive. We just didn't see that aggressively in the CPI. Employment change in Australia out tonight as well. We get the ECB meeting on Thursday. The euro is selling off leading up to that. A little bit of a question mark as to whether the ECB is going to continue down their path. Are they going to raise rates by 50 basis points as expected? What's happened in the past week brings more question marks, and I think the euro selling off tells you that there's at least a large contingency that anticipates that maybe they're not going to raise rates, or that they're going to stop sooner and so forth. So there is really some volatility around this event. And then on Friday, we've got the consumer confidence numbers, usually not a major market mover. Oftentimes kind of correlated to oil prices, which have been coming down. So I just want to have a good discussion about what's happening in the banking system. What is this run on the bank? This is the big story, and we want to understand it fully. So here's a chart of short-term treasury bonds, 1 to 3 year treasury bonds. Now these are considered to be risk-free, right? Because the U.S. government doesn't default, has never defaulted. They can print money, etc., etc. The financial companies own a lot of these bonds. Now, these bonds had been trending much lower in price, but remember, price and yield move in opposite directions. Yields, while prices were doing that, yields were doing this. And this was a huge problem for the financial companies that got it wrong in the bond market. Now, the ones that they got wrong were longer term bonds, more so than even these, but it's a problem in both, really. And they had a duration problem with owning a lot of the longer term bonds, but this will explain what was happening. So say you're Silicon Valley Bank and you want to make loans. Well, in many cases, you'll own a yielding asset and then make loans against it, and you'll kind of have, backstops. Because these are considered risk-free, these are considered cash. These are just like sitting your money in cash and doing nothing with it. But there's a problem when it comes to if you have to sell them early. If I buy this bond, let's say that I go out and buy 1 billion of these, just for hypothetical purposes. I buy $1 billion worth of these bonds, and then the bond price collapses like this. That doesn't seem like too big of a problem, because if I can hold to maturity, I'm still going to get the 1 billion back, right? The US government's not going to default. When they hit their maturity date, let's say it's a 5-year bond, in 5 years I'm going to get the 1 billion paid back to me. So no problem. Plus, I'll get some interest along the way. So I'll get all this money back guaranteed, and I'll pick up interest along the way. So in essence, it's cash, but it provides me some yield. And I can make loans against these bonds that I own, and so I can be making yield there. I go out and make, Silicon Valley Bank sends $1 billion out as loans and so on against this cash that's kind of protecting and backstopping it. And they make loans out there that they bring in 5 and 6 and 7% and so on. And so they're making money in a few different ways. They're making money on their cash by sitting it in risk-free assets, and they're making money on loans and so on. And this cash backstops their loans, where they know, okay, we have a safety net. This works as long as people don't come to pull their money out. As soon as people start pulling their money out, you become like the gym membership that's got chaos and confusion. The reason I explain it like a gym membership is, if you go and buy a gym membership along with thousands of others, they don't have enough equipment for everyone. But they know that everyone's not going to come at the same time to use the equipment, so they're fine, right? But if everyone with the membership shows up at the same time and wants to use the barbells, well, now you got chaos and confusion and upset customers and all sorts of problems. Well, the bank knows not everybody's going to come at the same time, right? People might pull some money out, and it might trend in that way, and we can make adjustments over time. But clearly, they're not all going to come at once, so we don't have a problem. Well, if confidence collapses, they might come at once, and now all of a sudden they want a lot of money back. Here's the problem. When you bought these bonds, their face value was maybe, let's say, $1,000 per bond. What have yields done since then, and what have the bond price done since then? Well, the price might have gone down a lot because yields went up in the market. And have yields been going up? Absolutely, right? We've seen interest rates rising from 2%, 3%, 4%, 5%, so on. Even the 2-year, it was yielding 5% when the bond price was down here. New bonds being issued were yielding 5. So this bond might only yield 2% or whatever. It's a lot more than that at this level, but work with me on this. Hypothetically, when they bought these bonds, they were yielding 2. Now the same type of bond might yield 5 in the market. So my bond looks really crappy. No one's going to buy it from me for $1,000 yielding 2 when they can go spend $1,000 for a new bond that's yielding 5. If I want to sell my bond with the crappy yield compared to newer bonds, then I have to sell it at a discount. So if yields go up, if interest rates rise after I buy my bond's going to lose value, because by comparison, it's not as good as the new bonds being issued. If yields go down, well, then my bond would have looked attractive, yielding 2, if they can only get 1, and my bond price would trade at a premium. Because yields have gone up a lot, prices of these bonds have gone down. But Silicon Valley Bank says not too big a problem, because we're going to hold to maturity and we'll collect this interest. Yeah, maybe we could collect more if we had waited, but we're making money. It's fine. We don't have to sell them early unless people come knocking. And now all of a sudden, they got to find money to hand back to all these depositors, right? And so they have to sell assets, and they have to come in here and take losses. And if you're selling a lot of your bonds, billions of dollars worth of them at huge discounts, you're locking in losses, which means that your equity, your survival is kind of diminishing right before your eye, because your banks work on some leverage, they might only have 20% or something. If they take 20% in losses, they might be wiped out. And that's kind of what happened here is they had to lock in massive losses. They had to sell these bonds at a loss to return money and so forth. And instead of being able to hold to maturity and being fine, they just didn't have that luxury. And that's what a run can do is it creates chaos, confusion. It can cause them to lock in big losses. And this is why I say that some of what's happening right now is bond prices are spiking back up and yields are collapsing back down, which relieves some of this stress. If banks do have to sell assets, well, at least they're getting more value for the bond when they're selling up here, if people are coming knocking and want their money back. So this does relieve some of the stress on these big regional banks. It does take some of the risk out, but I have to say that this is a little bit of a scary dynamic. When have we seen situations like this? We have seen situations like this in 2020. That's when you see huge flight to safety. It can get a little worse before it gets better, in other words. This is not, I think we're at kind of a short term bouncing point, but do I ultimately think we're going lower? Yeah, probably so. I wouldn't compare it to 2020. It's not like markets are, you know, collapsing before our eyes and every bank is going under and so on. I don't think that's the world we're entering into, but it does tell you that there's some real fear, some real panic, and some of that is probably not misguided. That there is some real stress in the financial markets. Who's the beneficiary of that? Well, safe haven assets. No surprise. I mean, if there's a recipe for Bitcoin to go higher, you want chaos and confusion and people to lack trust and confidence in currencies and markets and so on. This is when Bitcoin should do well. This is when people will flight towards the US dollar, surprisingly enough. This is when certainly people will flight towards the Japanese yen. So you look at the yen and it's kind of spiked up. It doesn't tend to run away from you. So again, I think equities bounce, yen should pull back. Do I want to be a buyer on the dips in yen? Yeah, I would absolutely look at it. That's a defensive situation, and I would be a buyer of dips in Japanese yen. I think there is some real stress, there is some real turmoil in the markets, and we need to respect that. So hope that kind of gives you more of an explanation, but again, we have to think about the future. Some of these things are positives for markets generally. Markets want stimulus, they want lower rates, they want Fed to stop hiking, they want a lot of the things that are actually more likely to occur now because of what's happening. What they don't want, though, is a weaker economy. They don't want stress and losses taking place in financial operations and banks. And, when banks stop trusting each other, now all of a sudden uh, the economy slows dramatically because they just don't trust that they can make these loans and do these things. They play it safe. They make sure they have ample amounts of liquidity. This tends to be when you hit recessions and a lot of turmoil. So short term, we can probably, again, get a risk on little bounce, which would see the yen pull back. But longer term, there's still some issues that we've got to deal with and some bad that comes from all this. So the rest of this week, we have the ECB press conference. We'll be trading that live tomorrow morning, bright and early. So come and join us for that. We'll have our recap on Thursday as well. And then, of course, we'll always finish the week with a trading room to review what happened last week and what is coming up in the week ahead. Hope you've enjoyed it. Have a great rest of your week, and we will see you next time. Goodbye, everyone.